industry.
Inside Analysis is your source of information and insight about how to make the most of this exciting new era. Learn more at InsideAnalysis.com.
InsideAnalysis.com.
And now, here's your host, Eric Kavanaugh.
Oh, yes, ladies and gentlemen, welcome to the future indeed. It's time for Inside Analysis, the only coast-to-coast radio show that's all about the information economy. Yours truly, Eric Kavanaugh, here with an all-star cast, folks. I'm really excited about today's show. We're going to dive into the weeds of fintech, financial technology innovation, how it's changing things, how it gets you your money faster, how it helps you keep track of money. And we'll particularly focus a bit on how it affects the CFO, the Chief Financial Officer, and how payments are done, right? Things have changed a lot in the last few years. Really, it's quite remarkable how different things are today than they were just 5 years ago, and mostly in good ways, quite frankly, mostly in very good ways. I can tell you that most of our clients these days pay us electronically. 5 years ago, they all paid by check. So I had to wait and hope the check came in and yeah, we sent the check. Okay, check is in the mail, right? That's an age-old expression oh, yeah, it's coming. Don't worry about it. We're going to talk to several experts today about what this all means for you and your business. We'll be hearing from Rob Israq. He is of Tipalti, the CEO. We have Marianne Azevedo from TechCrunch and also Alex Johnson from FinTech Takes. So a bunch of FinTech experts online today. And I'll just throw out there that I watched when Silicon Valley Bank collapsed, and I was like, oh boy, this could get rough because they had a lot of money there, a lot of Silicon Valley companies. It's been a stalwart for years. And Bill.com, who often pays our client money to us, they had $670 million sitting in Silicon Valley Bank. So I bet they were sweating some bullets. And of course, the creditors, the depositors were bailed out, not the bondholders, not the shareholders, but at least the depositors were bailed out, which is a good sign. But not all depositors are going to be bailed out in the future, right? FDIC $250,000 cap didn't come into play here so much, but it could in the future. So, but the bottom line is things are different. Things are changing quickly, and it's mostly good for all of us. And Marianne, I'll throw it over to you first, just for some commentary. You cover the space. You see what's happening. It's very exciting, but these are kind of tumultuous times. What's your take on what's happening in fintech right now?
Yeah, well, so I started covering fintech at the onset of the pandemic, and that was really when we were forced as a world to really embrace fintech, because all of a sudden you couldn't do things in person like you used to. You couldn't go to the bank as easily as you might have been able to, or just writing checks, and all of that became all of a sudden outdated. And so many people say that things that were in the works to happen, say 5 years down the line, were all of a sudden accelerated to happen in months to a year's time, right? Because of the need and the demand, and all of a sudden, more people wanting to pay digitally that had not thought they wanted to do that before, were kind of being forced to. So this digital transformation, as we say, it was kind of a cliche, was definitely accelerated. And we saw a boom in the fintech space, right? And we saw a ton of companies born, grow, emerge during this time, raise lots of capital, especially in 2021. Things obviously changed kind of overall in the whole market last year. We saw a big slowdown in the startup world in general. Fintech was no exception. It still was, I think, one of the top recipients of venture dollars last year, but it was about, I don't know, was it about half, I think, the rate amount that had been raised the year prior, which was still quite a bit higher than the years past. But the point is fintech is still a very hot space. It's still a very important space, but we are seeing kind of a shaking out and dust settling. And what you see left are the companies that really had viable business models, that really can do something to make a difference and continue to grow. Whereas there's companies that I feel like we're just there to sort of capitalize on the boom, that may not still be around in a few months or a year from now.
Yeah, I think you hit the nail on the head there with that term of crystallizing or accelerating, quite frankly, because you did have all these digital transformation projects on the dockets at large organizations. It was in the works to do something, but I'll just give you a quick quote and get your take on it. I had a guy who was the chief data officer for a big healthcare company, and he told me, and this is in probably early 2021, he said, we accomplished 5 years of digital transformation roadmap in 6 months. because of COVID. So it goes to show you that you can do things if you really have to. I mean, if it's a mandate, you're going to figure it out. And that's what companies did. So it was a forcing function to really crystallize a lot of these efforts that were already in motion, right?
Yeah, absolutely. It definitely was. And I think obviously, the fintech space, there were companies that already existed that were ready and in the right place at the right time. Then there were others that, saw opportunity and were born. So, obviously fintech is broad and expansive, and there's many segments even within the fintech space. And what we see today, though, is payments continues to be one of the top categories for transformation. And B2B also seems to be a very, I guess, what can we say is this enduring area of growth, because the business needs of businesses continues to be, large pain points when it comes to paying, whether it's vendors or their own employees. Like this is something that remains a big problem worldwide. So we're still seeing quite a bit of innovation going on in payments, particular, lots of B2B action as well.
Yeah, that's good news for us because we're a B2B player. So we want to see the innovation to get our money faster. And let's bring in Alex Johnson from FinTech Takes. And you've been tracking this space for a while now. I'm guessing you'd agree that what we really just saw was the crystallization of efforts already in motion, but in a very short time period, right?
Yeah, absolutely. I mean, I think the biggest change was just that everybody had to sort of jump into digital at the same time, right? I mean, you always have younger consumers or younger employees at businesses want to adopt new technology. That's just tends to be the way that they are. But a lot of the lag that we saw in the adoption of fintech and digital technology within banking, it was with older consumers and older employees and the managers or CEOs of these companies who were sort of used to doing things a certain way and didn't necessarily see a huge benefit in making a change. But during the pandemic, they had no choice, right? And the only way to operate and survive during that time was to embrace things that maybe some of your younger coworkers or your kids, if you're a consumer, were telling you. And so we saw a huge pull through in terms of generational adoption of fintech. That's not something that we're going to go backwards on. So even though we've sort of exited that stage of the pandemic and things are open up again, and you can go back to the bank branch now if you want to, a lot of people aren't going back to the bank branch.
That's a pretty funny way to put it. You can go back to the bank branch if you really want to. Not too many people are. And you made a really good point there as well, that this generational issue is very serious. I mean, I'm not going to lie. I kind of wonder sometimes, am I getting too old because I don't want to play around with ChatGPT all day? And that's like, shouldn't I be wanting to do that all day? And maybe I'll throw it over to Marianne for a quick comment before we get Rob in. Different generations have different norms, and younger folks, millennials, for example, are just more in tune with digital. They don't have the old habits that die hard of old timers like us who actually go to the bank and talk to a teller. Oh my goodness, what an experience. But do you see that as well in your research and following the industry, that, certain demographics pick up on stuff very quickly, certain demographics take a bit longer? What do you think?
Yeah, I mean, of course, obviously the younger generation, Gen Z, millennials are much quicker to adopt digital financial anything, right? Digital banking. I mean, because they're very much mobile centric generations, right? And that's a lot of them just grew up on their phones, and that's what they're used to. So, like, even the thought of going into a bank, it just is foreign to them. I think that's changing it, to Alex's point, to where even older generations are starting to really just get used to the idea. I think there was kind of a mistrust on the part of certain generations of like, well, I can't trust that my money's going to get to this place. What is this, sending it online? How do I know it's really going to get there? It might seem like an old fashioned way of thought, but there are a lot of people who just, they grew up for years, they paid very traditional ways, either cash or check, or they used credit cards, but, so it was a foreign concept. But even lots of members of these generations are getting used to the idea, and things like Venmo, for example. I mean, a lot of people use Venmo these days in our own neighborhood. When people sell things to one another in the neighborhood, it's, can I Venmo you? It's become like mainstream. Nobody says, can I write you a check?
Yeah. Even when I go to stores, there are signs that say, we don't accept checks anymore. It's like, wow. I saw a lady take out a checkbook. I was like, wow, look at that. There's a checkbook.
Oh my gosh. I stopped getting checks myself like 2 years ago. I just stopped. I quit ordering them. Wow. Yeah.
Well, because you had, I mean, just real quick, you had innovation in the rental space, right? You have companies coming in and taking payments for landlords. And then, of course, the upside of this, and we'll bring Rob in here in a second, Israq, president of Tipalti, to comment on this. But so the landlord, now I have a central place where I see everyone who's paid, everyone who hasn't paid. These kinds of reports and analyses are what make the fintech space so popular. What do you think, real quick, Marianne?
I mean, yeah, for sure. Especially like as you bring up, even things like paying rent. I mean, all things that used to be very, oh, let me drop my check in a lockbox type thing.
Right.
Again, I mean, these kinds of things are very outdated. And I think consumers or renters, people in general are starting to just expect to have these options. And if you don't have the option, you get frustrated and you wonder, why don't I have the option to do this anymore? So that's where it's all coming from consumer demand. And of course within businesses is different, but I'm talking in terms of consumers. People have come to expect it of all generations, and companies or businesses, landlords, whomever, if they can't offer a digital way to pay, they can lose customers. So it's become like not so much as a nice to have, but a must have for many businesses and companies to be able to offer things, people to pay for things digitally or conduct financial services in a digital manner.
Yeah, no, that's exactly right. And I'll bring in Rob Israq, president, not CEO, president of Tipalti. And you have a fun story about how this whole company came into being, and it really gets down to workflow, the value of automation, not wanting to spend tons of time doing boring manual processes that, by the way, are also error prone. And you don't want to make errors when you're writing out checks, and an additional zero is a big deal. But Rob, tell us a bit about yourself and what you're seeing in the marketplace.
Yeah, like you alluded to, the Tipalti was created, about 11 or 12 years ago. Our founder, who now is was a VC essentially and invested in many companies. One of his portfolio companies was an ad tech company, so at the cutting edge of the digital economy, and they were paying publishers all around the world, and they couldn't figure out how to do this. They're doing it manually, and they were looking for technology, and called up Oren Zev, who was the VC, and said, "Look, I've got this problem. I'm spending 1/5 of my time paying these publishers around the world. This is a web business, so again, that's a digital company, and they're intolerant of late payments or inaccurate payments.
Right.
And they're more modern, so they're expected. Certainly not. They're not going to be accepting check. They'd be accepting more modern payment methods, electronic, PayPal, etc. And couldn't figure out how to do this. And he said, "Look, if you can create a company that can pay these folks, I shouldn't be, as a CEO, spending my time paying these folks, every week. I'll be your first customer." And so Oren picked up the phone and called his former colleague from NC University, Chanamit, who's our CEO and co-founder. And he said, if you, kind of just sold a company, so he had taken a little time off and figuring out what he wants to do next. And he said, "Look, if you can explore this and see if there's a company, this can be your company." And so Chen explored it and talked to that company, talked to a bunch of others. And, it turns out that he validated there was a real problem around both managing the process of paying out to your partners, your freelancers, your publishers, your suppliers around the world, as well as automating the workflows related to it. Chen actually didn't come from a payment space. So he says, the fact that he didn't know that much about payments, that naivety actually led him to say, "Oh, this will be easy. I just need to identify the workflow, automate end to end, and I'll just embed the banking rails within it." And that's exactly what he did. But and we managed to partner with Citibank and Wells Fargo and JP Morgan Chase, which coincidentally is helping us right now during this crisis, and managed to get licenses and such. But we've essentially created a hybrid of automation workflow for finance, along with your global cross-border payments engine embedded right just as one of those workflows.
Yeah, now it makes a lot of sense, and it's understandable that banks would want to be very careful about things. And I'm guessing that one of the big hurdles for a company like yours to work with big banks is to make sure you have that security nailed down and airtight. You have protocols around remediation. Just connecting to their fire hose is a big deal. I mean, I know of some companies that do some of the most advanced data science work in the world, And they tell me that every one of these big companies wants to use their technology, but getting over that final hurdle of certification with all their security people, all their governance people, that takes months, if not years, just to navigate the process to be able to connect your host to their host. But I feel like we're there now. I've gotten one of my aha moments was a couple of years ago. We were looking to get some money to grow and make sure we had cash flow, et cetera. And we went to Chase and they're like, who cares? Leave us alone. Let's just go away. And we're like, okay. And then one day I'm in QuickBooks and I see this little ad show up and say, hey, if you have invoices you can collect now. There's a company called Fundbox. I'm like, well, how interesting is that? So I click on it. And you think about it, we've been using QuickBooks already for 5 or 6 years. So all that history is in QuickBooks. And when I can turn that over and open up the kimono, if you will, to the bank and say, okay, here's all the information I have. You can see how long it takes for people to pay us. You see what kind of money we're making. That's really valuable information for making a decision on a loan. It's much better than having some loan officer look at you. Okay, you look good. I think you'll make it. Signing off, right? So the whole game has changed, and it's because of data, right, Rob?
Yeah, exactly. I mean, the like you said, all the data is there in the system. It's all can be validated, it can be vetted, it can be used to transfer information from left to right. That improves your visibility and speeds up your decision making. You have fraud controls built in, financial controls built in, audit controls built in. So the digitization of these processes actually really sharpens up, speeds up, saves time, can reduce fraud if the system can do that and is intelligent enough to have those controls built in. But the whole ecosystem is just getting sharper and sharper and sharper.
Yeah.
And then you layer on AI on top, and the magic is close to being achieved.
Yeah, no, that's real cool stuff. And Marianne, I'll throw this over to you because I know you got to leave early, but what Rob just said, I think, is the key point, that you have all these innovators in a space, and yes, they overlap. Yes, they do compete at some point in time. But the fact that you have all this innovation and all this investment in innovation is really what's kind of crystallizing all this and bringing it together. Real quick, what are your thoughts, Marianne?
Yeah, and I think he raises a good point in terms of data, because data can be very, very useful in terms of predictive models, and that to me is really helps open up access. I see fintechs doing things like wanting to disrupt the credit space by, trying to challenge this antiquated credit score model, for example. And how do they do this? They use data. So I think this is really valuable, and I think it's part of why we're seeing a lot of disruption in the space is this use of data in the right places and building and analyzing over time. So I think we're only going to continue to see more of that.
Yeah, I think you're right. We're at the cusp of a really cool era, folks, where you can stay on top of how much money you have, understand the risk of investing in this option and that option. All this stuff gets fueled by data and analytics and even AI. Don't touch that dial. We'll be right back, folks. You are listening to Inside Analysis.
Welcome back to Inside Analysis. Here's your host, Eric Kavanaugh.
Take us to the future.
All right, folks, take us to the future indeed, where we all have a much better eye on the money and where the money's coming from, where the money's going, how much of it we have, what our risk exposure is. These are the topics we're talking about today. We've got Rob Israq from Tipalti and Alex Johnson of FinTech Takes on the line. And Alex, I'll bring you in to again talk about the Silicon Valley collapse and what it means for all the rest of us. I guarantee you, even I was sweating bullets because a lot of our companies use Bill.com, and I'm like, oh boy, if they lose 2/3 of $1 billion, folks, that's what they had. That's the report I saw. 670 million smackaroonies are sitting in SVB when it collapsed. So they were pretty happy when the feds decided to save them. But you had a great analogy for describing how they got in this trouble, because they invested in these 10-year treasuries for 1% interest. That was a pretty high risk endeavor. What are your thoughts?
Yeah, I mean, they, like a bunch of banks, were just swamped with more deposits than they knew what to do with, right? And a little banking thing that not everyone appreciates is that deposits are liabilities to banks, right? They have to get rid of them. They don't want to have them on their balance sheet.
What a great line.
Yeah, the deposits are liabilities. And so what do you do with those? Well, hopefully you can lend them out. And that's what a lot of banks did. Silicon Valley Bank didn't ever have a huge lending business, and so they couldn't do it that way. So they reached for yield with these treasury bills that they bought. And the treasury bills by themselves, treasuries are the safest thing you can possibly invest in. So it wasn't like they were making bad loans. But what they did was they reached for a little extra return by, instead of getting a 1-year treasury bill or a 2-year treasury bill or a 5-year treasury bill, they went for a lot of 10-year treasury bills. And this was when interest rates were really low. And so they reached for that little bit of extra yield. And it turned out that that was a huge risk. The analogy that I've heard that I really like to describe this is they sort of were running around in front of a steamroller trying to pick up pennies, which is a valid thing you can do if you really want to, and you're trying to put a couple extra cents in your pocket, but it's not something that like parents would encourage their children to do, right? It's pretty risky. And as it turned out that once the rates went up, it turned out a lot of the bonds that they bought ended up underwater. They were worth less than what they paid for them.
Oh.
And that combined with the fact that venture-backed companies, which were the main customers of Silicon Valley Bank, they were running out of money, and a lot of deposits were leaving the bank, and suddenly they found themselves in a shortfall.
Oh.
And before they knew it, they had a run on the bank. And that was, I think, the other part of the story that was interesting was this was the first Twitter bank run, right?
Right.
The last bank runs that we had were way back in 2008, 2009, where obviously we had the internet, but we weren't all kind of constantly plugged in the way that we are now. And I think I saw that on that fateful Thursday, about $42 billion, which was 25% of all the money that Silicon Valley Bank had, left in one day, which is 23 times faster than the previous record for a fast bank run. So
wow. Yeah, that's not good. You don't want to see that happen. And so now, of course, we have to find our way out of all this. And in the break, we were just chatting, and Rob, I'll throw this one over to you. There is a tremendous amount of value that can be gleaned by leveraging fintech technology on the data sets and the processes and workflows of big banks. And of course, the ledgers, to understand what you have. And that's part of the challenge, if you're really big, is having a full understanding of what you have, where the risk is, what could possibly happen. I mean, these are things that chief risk officers are supposed to oversee the management of. And of course, SVP didn't have a chief risk officer, at least in their UK branch, for like 8 months or something, which is just unbelievable. I mean, a huge mistake. But I think going forward, it's really in that overlay of technology on existing data sets and workflows and balance sheets that's going to help us navigate through. But what do you think, Rob?
Yeah, totally. The use of technology can allow you to understand where your money is, in which bank account, in which entity around the world, what controls you have in place, what different fraud protections you have in place, speed up your financial close. A system like Tipalti will accelerate that by about 25%, which essentially is better business visibility. I will say that the technology has that potential to help on that. On the banking rail side, you do want those companies that you're partnering with to have licenses, whether it's in the US and the UK, other jurisdictions. You want to make sure that they're also going through their own version of regulatory controls and have their own KYC process and due diligence and the such. You want to make sure that they're partnering with reliable banking partners, blue chip type banking partners and other types of respected entities. It wasn't that long ago that we thought SVB was one of those, but the more blue chip, the more regulated, frankly, they are, the safer they are. You can go back to a few administrations ago where they watered down the regulations on the regional banks, and that is one of the culprits that led to where we are today, even though there were other missteps by SVB and other banks as well. And so those are things that you want to make sure you've got high quality partners in terms of who you're working with, that you have banking redundancy. That's something that you have to think of from a treasury perspective, and of course then the technology enables you to have the visibility to make the right decisions, have the right controls to optimize your finance workflow and the way you're operating safely.
Yeah, and things have changed so much, which means you need to change the rhythm of your business. And what I mean by that is, you used to be able to check at the end of the month, okay, where are we? Then you would check like weekly. And now, I mean, depending upon your business, you got to check all the time, like every day, depending upon what your portfolio looks like, right? We got a war in Ukraine that's now a year in. We've got energy prices that have spiked significantly. We have inflation. There are all these factors. And of course, rising interest rates. I think what kind of turned the whole industry upside down is the fact that we had these interest rates spike very quickly to fight off inflation, but not enough of the key people in key positions did the math on that to understand, hey, we have to unwind these positions or we're going to be in big, big trouble. Right. I mean, you have to think that as interest rates are climbing up, that's when, CROs are like, okay, let's take another hard look at what we've got going on here. And clearly that did not happen, at least with the right people at SVB. Right, Rob?
Yeah, absolutely on the SVB side, and from the business side, it's changing how companies have to watch their cash flow, have to manage their treasury. There's things you have to change to your business model planning to make sure you're optimizing and minimizing the interest rates you're going to have to pay on, let's say, a debt facility or a loan. You have to think about the repercussions to your customers and essentially have sensitivities, which is one of the things that SVB didn't have, but sensitivity models for your business, anticipating what if interest rates go up, go down, what could the impacts be on our customers, how do we make sure that our money goes the furthest so that you don't have to tap into your debt facility and spend more money on that from an interest perspective. So there's a lot more variables along with all these kind of global socioeconomic issues happening around the world. So you definitely have to stay on top of things a lot more tightly than you used to.
Yeah. And Alex, I'll bring you back in. You got this concept you threw out there of the CFO in your pocket, right? And these days you can have tremendous visibility and analytics on data if you have the right technologies in place to kind of watch and to do what scenario modeling, right? Monte Carlo assessments. This is what banks have been doing for a long time now, but now you can do sort of mini Monte Carlo assessments with, smaller data sets or even large data sets because the tech is so good. And that's what you have to be doing, is constantly assessing what is the upside potential, what is the downside risk, how is that changing, what policies can we change? You got to know what you can change when the situation changes if you're going to change it effectively, right?
Yeah, I mean, one of the criticisms of SVB and the whole situation was, well, how could those businesses that were banking with SVB be so stupid as to keep more than $250,000 in one of these accounts? Don't they know that's the cap for FDIC insurance protection? And I think that's kind of an unfair criticism, honestly, because a lot of these companies they're small businesses, right? They have 8, 12 employees. They don't have a chief financial officer.
Right.
But with software, with fintech, to your point, we can digitize a lot of those functions and we can kind of put like a master CFO in your pocket, and they can be automatically monitoring your treasury and your different bank accounts, and they can be balancing the funds across multiple checking accounts that you have, so that even though you have $8 million sitting in the bank, you actually have it spread out across a bunch of different checking accounts, all underneath that FDIC insurance limit. There are ways to solve those problems, and that's what larger companies with more resources are already doing in a manual way. And the fintech is, it democratizes access to those tools so that everyone has world-class CFOs and CROs and product leaders and all kinds of different functions in these businesses sitting on your phone. And that's the advantage that it gives to everyone and kind of levels the playing field.
Yeah. And, Rob, I'll bring you back in. When I think about what's possible these days, and really it's such a fast moving market that you have to keep your mind open to new ways of doing things. And these days, you really can get much better intelligence on existing data sets, in part because the data sets have been around for a long time. So you can do this sort of regressive analysis to understand, okay, well, back then, if I had done this, what would that have done? These kind of scenario modeling episodes. And even though you may never plan out the exact right strategy, what's that old quote from Eisenhower? I've always found that plans are useless, but planning is indispensable, right? In the process of planning, you're going to learn things and you're going to figure things out and then be able to apply that knowledge and the moment that you need to do so. And talk about, when pressure is on. I mean, Janet Yellen, when SVB collapsed, first she said, no bailout. I was like, what? Oh, no. And then she said, all right, we're going to bail out depositors. Like, all right, well, that is a bailout still. Not bailing out the bondholders or the shareholders, but it is at least bailing out the depositors, which I think is good news. But then you also don't want to give, a bad impression or encourage more bad behavior, basically, right? There have to be penalties for these things. So there are things that can happen. But you want to be prepared for the moment when you need to make the decision, right, Rob?
Yeah, you want to have the data, the systems, the process in place that ensure that you're safe from an audit perspective, that gives you the data and the history of data you need to make decisions. The other piece is sometimes the data is not going to tell you what to do. And the CFO or the controller or the finance leader of the business, you want them guiding the CEO to make better decisions. You want them available to change the business model on a fly if you need to and start kind of running different scenarios. And you can't be spending all your time in finance doing these manual processes.
Right.
And so the more you can automate those and keep them safe, keep them controlled, give you the right visibility, but free up the time of the finance team to do what the finance team knows. They're one of the few people in the entire business that know the version of the truth of the company. Given we've had 14 years of good economics until last year, essentially, CEOs, marketers, CROs, they're very growth oriented, but they weren't always the best with the data. They certainly weren't best with balancing data with costs, cash flow, all these things. The CFO, the controller, the finance leaders in the company are probably the single most valuable people in the company to really understand how to manage a complicated situation. You want them using their brains and using what they went to university to do, and not worrying about all these financial processes and operations. You want to free them up, and that's essentially what automation technology does. It also gives you the better visibility and keeps things under control, puts the right cost controls and fraud controls in place, but also frees up those folks to help your company figure out how to navigate things like COVID, Ukraine war, energy prices, interest rates, disruptions of banks and the such like that. So, you can kind of get the most value out of them guiding the CEO and the board to make the best decisions.
Right. Those are all excellent points because, again, a lot of times the finance people don't know the inner workings of the business and which department is more responsible for this or for that, but they certainly do know the financial side, and that's really important. And, as you're talking, I'm just thinking to myself, let's say you've got, in this scenario, one really big client who's always been paying you on time, but they were banking at SVB, and you're like, we're not going to get this payment. Having the capacity to automatically slow down payments, for example, let's say you're always doing 30, maybe you push it to 45 or something with the click of a button, that can be very helpful to slow down the hemorrhaging, right? Because otherwise you're just like, you could capsize, which is what happened to SVB. And that's one of the cool things you can do with good fintech technology, right, Rob?
Yeah, absolutely. And if you're partnered with folks who have multiple redundancy of banks, you can also move. Let's say you have one bank that does collapse, but you have other banks you're partnered with that haven't. You can move that money instantaneously to a safe place as well. And so these are things that you can touch the button of, make quick modifications, quick pivots. Even from that perspective, take advantage of different changing currency and interest rates for conversion optimization. So there's all kinds of different techniques and ways you can take advantage of the technology.
Yeah, I think the bottom line is you want to have the agility, you want to have the knowledge of what you have, of where things are, and you really need to understand your processes and your workflows. I think we'll pick this up in the last couple of segments. You got to understand your processes, who's in charge, what the workflow looks like, what the latencies are, and then the intelligence on your existing customer base. Who pays you quickly? Who pays you the most? Who pays you in somewhat of a tardy fashion? And guess what? You can also find leading indicators and lagging indicators, for example. So you can look at the data and see, all right, if I have someone who's always paying on time and then they're not paying on time, they're getting further and further behind. Well, guess what? They're probably falling behind is what's happening. So if you have that information, you can take action, reach out to them and say, hey, is there something we could do to help you? Here's some advice that we have. Do some partner relations, basically. All that stuff goes a long way to maintaining strong partnerships. But folks, don't touch that dial. We'll be right back. You are listening to Inside Analysis.
Welcome back to Inside Analysis. Here's your host, Eric Kavanaugh.
All right, folks, back here on Inside Analysis, having a fascinating conversation. We have got Alex Johnson of FinTech Takes and Rob Israq from Tipalti on the line. We had Marianne Azevedo as well from TechCrunch. And things are moving very quickly. That's what we just ascertained in the break. I think it was Alex who said in the old days, like the bank runs were hard because you had to actually run to the bank and wait in line to get your money out. Now you don't have to do that. You could do it online. You could do whatever you want. And I wonder if we're going to see some more controls come in place here about mass exodus of money and like trying to slow it down. But how do you do that in a fair and equitable fashion? That's a hard thing. It's a hard nut to crack. But I can tell you that fintech can certainly come in handy, because with fintech, you can have various dials and various levers you can pull and dynamically persist across all account bases and say, hey guys, is it better for you to wait till tomorrow to get your money or for you to lose all your money? I think most people be like, that's actually a good point. I would rather not lose all my money. So I will wait till tomorrow. But I'll throw it maybe over to Rob to comment on first, and then Alex, what are your thoughts?
Yeah, I mean, you take what you're just talking about, Eric, and you layer on AI, which can really, add that layer of additional logic, making meaning out of all that data. Obviously, maybe with some controls in place there to make sure it doesn't actually reinforce a bank run, but
Right.
but yeah, it can be powerful.
Well, there was that case of wasn't it? It was Zillow, I want to say, that was getting into buying homes. And they had their little algorithm out there, like finding homes. And then something, I think what happened is that, there is this tricky issue of a home valuation being based upon other sales in a market at a certain time. And it was just basically one little I they didn't dot or one T they didn't cross. And they wound up getting their, hat handed to them on that issue. So you have to be very careful with powerful technology like AI. You do want a manual override. You do want to be watching this stuff. You can't just turn over your decision making to a black box AI. I mean, there are laws and regulations around that. But just in general, I'll throw it over maybe to Alex to comment on. We have all these very powerful technologies now, but you need the guardrails and you need to make sure people are educated on how to use them. Right, Alex?
Yeah, that's exactly right. I mean, the guardrails exist because as much as we are digitizing a lot of this stuff, at the end of the day, there are people at the end of all of these processes, and people are irrational. People are sometimes not reliable, right? Like the Zillow story really comes down to the fact that they were buying all of these houses that were probably a good investment, but the thing they overestimated was how quickly they would be able to flip the houses and put them back on the market. And what they ended up running into was there weren't enough contractors in these neighborhoods that they were buying houses in. So they couldn't get someone to come in and paint the house or replace the carpet or whatever. So it's like a very human problem. I think anyone who owns a house right now has probably been going through a version of that. And so they had this wonderful model that was predicting all this stuff, but it ran into a very sort of human real world constraint issue that, as you said, ended up losing them a lot of money. And I think that like Silicon Valley Bank and everything that we learned from that is very much the same. Like, it's great that we can move money in real time. We're going to have in the US FedNow, which is a real-time payment system that's going to make it easy for money to move instantly rather than having to wait the 2 to 4 days that it takes to settle ACH payments. So we're going to have faster infrastructure. But the question is, what guardrails and controls do you layer over that? Because it's not always good for things to move as fast as they possibly can.
Right. No, that's a really good point. And Rob, I'll throw it over to you. It's a fun, exciting time to be in this industry, but it's also a bit of a risky time because you have to stay on top of what's happening and you have to understand how that's going to impact your business. And that gets down to understanding the balance sheet for sure, but also back to workflow, back to basic workflows. And I like the story about how Tipalti came into being because you had someone who wasn't from the payment space, but did understand automation and workflow and software. And that's almost better. And then later connected to the fire hose, right? But at least nail down the processes, because that is some pretty tricky stuff to pin down, and understanding, what framework you're going to use, what architecture for the software, et cetera. It's important to understand all that. And it seems like you guys figured some stuff out, right, Rob?
Yeah, I mean, I would say, when you look at the various different types of technologies out there that, fintech's taking advantage of, automation is still the center of the game. Particularly in this kind of economic volatility, but even beyond that, ultimately, where tech adds the most value is freeing time to allow people to do what they love to do what they're best at doing, and process automation and looking at what are those processes that are repeatable, that don't require, that can be exception based, and how to streamline those processes so that the staff you do have, the people you want to invest in, can spend their time in those things that add the most impact to the business. In the case of Topalti, Chen was able to sit down with people who had this pain and notice they were describing their problem at that point as cross-border payments. But when he actually looked at it, he said, actually, it's not. We're serving a lot of digital companies. They were onboarding tons of different partners, freelancers, contractors, publishers, talent, etc. And he realized, okay, if you get the onboarding wrong, you don't do the right validation of the payment information. If you don't do things like OFAC and sanction screening checking, you get fraud. If you don't check this stuff up front, you get payment error rates being very high. Then you have to connect it to the banking rails. You have to think about tax ID collection and all these different interdependent processes that you may not connect the dots with. But in order to get that process streamlined as possible, all those dots have to be connected. And by stitching them all together, automating that's where you get that huge, 80% plus workload reduction that then really frees up that CO in that example I told you earlier to actually do his job as a CEO and run the business versus having him or his team running all these manual processes. Right. And then on top of that, then you add the controls, the AI, the other technology. But the foundation is really automation of that workload, right?
Yeah, no, that's a really good point. And, I'm just thinking to myself here, in organizations, you have your finance department, accounts payable, accounts receivable, et cetera. You got your marketing department, sales department, content, who's ever doing, the bulk of the business, what the business is actually selling, right? Then you have all that support around it. And you talk about the finance stuff. Well, bills have to get paid. So like those people have to close the books, right? And I remember, 20 years ago, talking to a client of ours, and they did some really good technology hierarchy management for banks to be able to do roll-ups and things of this nature, analysis. And, they would explain to me that in the banking world, like 80% of their time is spent on exceptions, right? So in other words, 80% of stuff gets done in 20% of the time. And that last 20% is like, oh my God, the exceptions are a real pain and you have to track them down. You must get that done. And that's a real driving force, I think, for innovation, but also for fear of change, maybe, Alex, because they're like, well, I got to make sure I get my job done here. So you got some new tech. Are you sure it's going to help me? Because if it doesn't help me and I'm spending more time on it, I'm in big trouble. What do you think, Alex?
Yeah, I mean, that's the issue with anything that touches money, right? Is that if you screw up, the consequences of that are massive. And you certainly lose your job, has a huge negative impact on the company. And so there's just a very sort of conservative strain of thought, which is, we're not going to change this. Like, it works well. We have this staff of people who are doing this job today. Sure, the systems they're using are a little bit kludgy and kind of duct taped together, but they know how to use them. They're comfortable with them. And I think something we take for granted in financial services a lot when it comes to technology is these old legacy systems, say what you will about them, but they work, right? They don't break. They're coded in COBOL, which is a language that no one even knows how to code anymore. And all of them have retired by now. Or if they haven't, they're working for a state government updating some system. But, in banking, those systems are very reliable. And so when you go to a bank and you try to introduce these new systems or, new ways of doing things, I'm sure Rob's had this experience a bunch, you have to get past that initial fear of change, because the one thing they know is the thing works today. And if you're introducing something new, that's introducing a chance it's going to break.
Yeah. That's right. We don't like operations people are like, if we don't broke, don't ever fix it. Just don't touch it. Don't
look at it. Right. Like,
that's right. Don't look at it funny. That's funny. That's a really good point, Rob. We've got about a minute and a half here before the podcast bonus segment. These are very real concerns, but I think that the handwriting on the wall is so brazen that companies realize we have to do something, right? We have to start looking into what part of our payments we can automate, what part of our financial picture we can really nail down. And I think that's probably good news for you guys. What do you think?
Yeah. But having said that, you need to be careful with the process. You should look at, again, are they licensed? Who are their banking partners and their business partners? What are their online customer reviews? Do they have case stories, testimonials, validation? Can you see a live demo of the product so you can kind of make sure it fits your business? You can ask kind of complex questions to make sure it fits your unique business workflow. Is the system modern? Is it easy to use? Is it going to require huge amounts of change management or 6-month implementation processes? Ideally, it's the opposite of what of a long time frame, and easy for people to both learn how to use it and easy for new employees to get used to it. And so those are all the types of things that you you want to take a look at, and make sure you're partnering with someone that you can trust, that will make sure that that it doesn't backfire, but it actually delivers that ROI.
Yeah, no, that's exactly right. That's exactly right. Well, folks, send me an email if you want to be on the show, info@insideanalysis.com. Podcast bonus segment is coming up. You're listening to Inside Analysis.